Good afternoon and welcome to our regular preparatory meeting ahead of the monetary dialogue with the ECB President, Christine Lagarde, that will take place again on Monday, the 6th of October in the evening in Strasbourg. For this monetary dialogue, apart from regular quarterly assessment of the ECB's monetary policy stance, econ coordinators have selected a topic on the currency dominance implication of a stronger international euro. In today's meeting, we will hear a presentation and discuss with three experts. Mr. Christoph Bold will provide his insights on the opportunities and challenges of enhancing the euro's role as a global currency. We have an expert on the topic connecting remotely who will provide her views, Mrs. Beatriz Veda Di Mauro. Thank you for connecting. In addition, today we are also welcoming Mr. Ravi Balakrishnan, who will present his remarks on the assessment of the ECB's monetary policy. I will introduce them more in detail when I give you the floor. Of course, this session is web streamed and will be conducted in English without interpretation. Let me maybe make a couple of opening remarks to introduce the topic. 2 weeks ago, September 11th, the ECB decided to keep the three key interest rates unchanged for the second consecutive time. The key policy rate, the deposit facility rate, stands at 2%. And in its communication at the press conference, the ECB made clear that the headline inflation is currently at around 2% medium-term target, and the assessment of the inflation outlook is broadly unchanged. To determine the appropriate monetary policy stance, the ECB reiterated it will continue to follow a data-dependent and meeting-by-meeting approach, as always. The ECB staff macroeconomic projections were also released 2 weeks ago, and the projection supported a less severe outlook for the downside risks of the economy. GDP growth in the euro area is expected to reach 1.2% in 2025, 1% in 2026, and 1.3% in 2027. Regarding headline and core inflation, the ECB has maintained its outlook with no material revisions compared to 3 months ago. Considering other challenges, the current concerns surrounding the dollar present a historic opportunity to strengthen the euro's global standing. The EU is currently pursuing a range of initiatives designed to enhance the international role of the euro. In practice, these take the form of concrete measures aimed at addressing structural barriers that have limited the euro's ability to catch up with the dollar. While a dominant global currency entails both benefits and challenges for the issuing monetary area, the approach of EU policymakers, including the ECB, has evolved over time, shifting from benign neglect, where the euro's global role was left to market forces, to a more proactive policy stance. In particular, latest market and policy developments in the United States raise questions on its future global dominant status, forcing a reflection on our side of the Atlantic on whether we should more forcefully push for a stronger international role for the euro. Overall, 5 papers will be prepared on the 2 topics for the upcoming monetary dialogue, and all will be available on the Monetary Dialogue's website. Allow me maybe a personal comment, since I'm one of the negotiators of the digital euro. This is a topic of key concern for the considerations of how we design the digital euro going forward, and therefore I'm very much looking forward to, of course, the interventions today, but also the papers in order for the preparation of the monetary dialogue. So I think we can start right away with Mr. Christoph Bold, Deputy Director of Analysis and Forecasting, Deputy Director of Analysis and Forecasting Department of the OFC. It's a pleasure to have you, and I give you the floor for 10 minutes. Thank you.
Okay. To share our views on this issue of international monetary system. Okay, it's better like this. So, thank you very much. So this is a joint work with some OFC colleagues, Jérôme Krill, François Gérolf, and Giovanni Rico. And what we aim to do in this paper is to assess the role of the dollar and the potential role of the euro as an international currency in the current system. Okay. So the starting point of our analysis is that something that we should all be aware of is that the US dollar has been dominant in the international monetary system since the Second World War. Despite 2 major events, this dominance has remained. So the end of the Bretton Woods system has not put an end to the dominance of the dollar, neither has the creation of the euro some 20 years later. Okay, but At that times, it was thought that the euro could be a real potential rival for the dollar because it was the second largest economy, which plays a major role in international trade. Okay, so we'll come back on the more in details on the potential of the euro, but we should also talk about the dollar and what will be the future of the dollar as an international currency. Just to remind first things which are quite important, that why is the dollar is an international currency? Here it's because it fulfills three functions, notably so it is at an international level a store of value. What does it mean concretely? It means that most of central banks' foreign exchange reserves are held in dollar, and the private financial sector also a large bulk of assets in dollar. Okay, it is also a unit of account. Major commodities are priced in dollar, and international trade is invoicing is mainly in dollar, notably when you have two countries which have trade relation outside the US. Okay, and then it's the medium of exchange also. So 90% of exchange rate transactions on exchange rate markets involve the dollar. So it shows us the role and the importance of the dollar. Where does this role come from? So we developed in the paper, I guess that we won't have time to discuss this here, but we developed this in the paper, a short history of the dollar supremacy to explain the key episodes that have helped to build this dominance of the dollar since Bretton Woods II. So I've put some examples in the slides here, but I won't come back and detail them now. So maybe we can skip to go to the second slide and discuss about the role of the euro now, and see, so what is the current role of the euro? The role is not dominating the system, but it plays an international role. It means that for all the functions that I mentioned before, the euro is playing this role. So it is a store of value in the international monetary system. It is also it involves some international trade invoicing, and it is a medium of exchange. But it has a second place behind the dollar. So it is an important international currency, but it remained behind the dollar since the creation of the euro. Okay, so we see on this chart some several dimensions comparing the role of the euro and the role of the dollar. So on all these issues, foreign exchange reserves, the issuance of international debt, loans and deposits, and the foreign exchange turnover, we see that the euro plays an important role, but it's far behind the dollar. Okay, so why it is also an important issue? Because we see some signs of fragility of the dollar dominance. And we can wonder whether these are structural trends or only short-term trends, okay? And there are also some issues about the strategy that will be followed by the US governments. So it means that the international use of the dollar will also depend on the US will. What do they want for the dollar? And then the final point is the international role of the euro will depend on its ability to circumvent some structural barriers that I will develop later. So if we go to the next slide. So let's talk about talk about the erosion of the dollar dominance. There are short-term trends and medium-term trends. Okay, so recently, since the second mandate of Donald Trump, we have seen an important rise of economic policy uncertainty, which is related to the trade policy and the trade war, which has been started by Trump at the beginning of the mandate. We have also seen some threats on the Fed independence, with the will to influence very strongly the decisions of monetary policy of the Federal Reserve. Okay, so this has triggered a very important rise on the economic uncertainty, which is here measured by some indicators based on the research of American economists Baker, Bloom and Davis. So we see here that we have a peak, the strongest peak for the global index of uncertainty since the beginning of the 1980s. Okay, so it's strongly related to trade policy because we have seen there were some threats, some increase in tariffs. Sometimes they went back on what they said, and so this has triggered lots of uncertainty. But it's also uncertainty related to monetary policy and to fiscal policy, with some announcement about the next budget, and also the announcement of a strong measure that will increase the US deficit, and then that may also increase public debt in the future. This may explain, so we can see this in the next slide, that these elements may contribute, well, have contributed to the depreciation of the dollar that we can observe since January 2025. So this is the upper chart here with the dollar-euro exchange rate, the euro-dollar exchange rate. So it may explain, or it may have undermined or reduced investors' confidence in the role of the dollar, and they may maybe seek for another safe haven that can be the euro. We will see that later. The second point, which is below, it's the interest rates on sovereign debt. So we see that not necessarily since January, but before that, we have seen an increase on the interest rates on the US debt, and we see some gaps, an increasing gap between the interest rates on the 30 years debt compared to the 10-year debt. Okay, so that's some short-term trends that may show that we have some signs of erosion of the dollar. But it's not only short-term trends, it's also medium-term trends, which have been documented by some research, some academics who have shown a declining role of the dollar since the beginning of year 2000. And so this is only one illustration of that, but we see that there is a decrease in the share of the dollar in the foreign exchange reserves, a 10-point decrease, which has been notably documented by Arsalnap and other authors, but they are not the only one who have shown this. And the explanation is that there may be some international will to diversify exchange rate reserves that has benefited to non-traditional reserve currencies. We see that it has not strongly benefited to the euro. They also say that and show that central bankers may behave as portfolio managers that may seek a better return for their exchange rates, and it can also be a side effect of the sanctions that can be imposed sometimes for the US. So at the short term, it's a way of the US government to show the dominance of the dollar, but in the long term, in the medium term, it can also undermine the confidence in the dollar. Okay, so we have short-term and medium-term dynamic showing this erosion of the dollar. The next step is now what will be the outlook. What is the outlook for the dollar and the euro? To discuss that point, we need to focus on 2 points, 2 issues. The first one is what is the strategy that is pursued or contemplated by the US. It's not that easy to see that through. So to us and to me, it's not that clear what is the precise strategy of the US government about the role of the dollar. What we see is that there is some elements which has been presented by Stephen Mirans, who was an economic advisor of Trump's during the campaign president, and who is now a member of the FOMC. So if we look at what wrote Mirans and what are his views, so he recognized on the one hand that the US have benefited from lower interest rates and lower borrowing costs due to the role of the dollar. This is sometimes related to the exorbitant privilege that the currencies which is dominant in the system help to issue more debt and to have, because they have more demand. Okay, but at the same time, the important demand for dollar may have weakened the US competitiveness, may have lead to an appreciation over evaluation of the dollar that may damage industrial production and the employment. Okay, so this is the consistency of the argument, and what is then proposed, and the view that may change these things according to Miran. It's a new international monetary system in which we would have a new coordinated international agreement like the Plaza Accord in 1985, where countries have agreed to let the dollar depreciate. So it would lead the governments to accept this depreciation of the dollar, and with the aim to restore the US competitiveness, okay? And what is the role in tariff in that discussion? The tariff may be used to encourage or to bring countries to negotiate this kind of accord, okay? So that's a very short view of short synthesis of this view. Then, so on the one side, so we have some issues and discussions about the dollar, what will be the future of the dollar. But then the question that arises is if the dollar plays a less important role in the monetary system, can the euro be a strong rival? So this is an old premise that was formulated at the beginning of the euro, and it was sometimes anticipated by some academics saying that that the euro could surpass the dollar at the beginning of the year 2020, but it did not materialize. One thing that we should mention about this paper that they said that there is a strong condition was that the UK would join the euro, which has not been the case, as we all know. But this is not the only thing that may be important for the role of the euro. The point is that in the international monetary system, there is some view that the dollar could benefit from a first mover advantage and network effect. It means that once you are the dominant currency, you have strong inertia and you remain the dollar the dominant in the system until there is some big shock that may change the things, okay? So there is an issue and a discussion on whether there can be a multipolar system or whether the system will remain unipolar, centered around the dollar, okay? But the main thing about the potential role of the euro is that it faces structural barriers, okay? So this is maybe more the most important point here, because we have political fragmentation, limited fiscal integration, and shallower capital markets than in the US. That may put some brain to the role of the dollar. Okay, so the key point is that the scale of EU debt market remains quite small compared to the US Treasury market. Okay, so if we want to strengthen the role of the euro at an international level, we need to create large and liquidity Eurobond markets and permanent Eurobond markets, so beyond what has been decided with the Next Generation EU plan. That we need to provide more liquidity on euros. Of course, digital euro will help and play a role in the international role of the euro. And some reforms also will concern the role of capital markets and deepening the capital markets to increase the size and issuance of investment in euro. So if now we go to the conclusion. The euro remains the main plausible alternative to the dollar in the current system, but as I've just said, it faces strong constraint. Okay, and my view, and maybe it's not only an economic constraint, an economic issue. It's mainly a political issue. Okay, one of the big things to make the euro more important in the international monetary system would be to have really important and deep liquid market for debt, for safe assets that we do not have for the moment, as long as we remain with a fragmented debt market. Okay, so and behind this issue, for sure, it's not only an economic technical problem, it's mainly a political issue, which has strong implication if we want to go to further fiscal integration to make the issuance of those Eurobonds more important to be allowed to revise the dollar more permanently. So my view is that the system may remain quite unipolar with a strong role of the dollar. Of course, the euro will remain an important international currency in the system, but we don't see for the moment the conditions fulfilled to make the euro real rival of the dollar in the current system. So thank you very much for your attention.
Thank you for the very insightful presentation. I would say we go directly to a little bit of a debate. So if the members have any questions, feel free. Mr. Papandreou from the Social Democrats.
Thank you for the presentation. I was a little late, but I think I got the gist of it. So what my opinion, what Myron is trying to say is we want the United States dollar to remain reserve currency, but at a lower level. So it's hard for him to do that. You can't do it with a free market, so he's trying to do it through trade agreements and through the threat of the tariff. It's not clear they can do that. What our question is, and ours should be, do we want the euro to be get to a reserve currency because reserve currency means this whole panoply of military and global dominance. It's not just an economical thing. The dollar is there because there's a sense of security that U.S. will make things work. That might be a fake, but that's the idea. So I don't know if our strategy should be to have an increase to make the euro more of a reserve currency, given that reserve currency means many other things. It's a question. It's not something that I can answer. The more that euro becomes, if it goes up in percentage, the more responsibilities come with it besides pure financial. There's a political element. That's sort of a question of strategy.
Yes, that's a point on which I did not put so much emphasis in my presentation here, but which is also explained in the paper, that the role of the dollar goes with some strong geopolitical dimension, and it's not only an economic dominance; it's also a political and a geopolitical dominance, which we can see through lots of ways. And the issue is that. So it was the same for the pound before the role of the dollar. So it goes along in parallel. Okay, so we insist on the economic dimension here, and that's what I've done here. But of course, it raises the issue about the real political dominance of the Europe, which is bring us back to political fragmentation. So I guess that it's more a political issue, and all those issues and all those questions are more related to political issue about Europe. As long as we are quite fragmented, it's fragmented on the economic issues, but also on political issues, on foreign policy also. So it doesn't mean that the euro does not play a role. It does, and it can be increasing. Okay, we can have Europe still fragmented, but playing a more important role in the current geopolitical system. It goes beyond my research to talk about those issues, but I think that we can play a more important role in defense and so on. That's the plan. So it can go on that, but I guess that as long as we are in that situation, it will put some limits in the way it can really be the first and the main important currency in the system.
Maybe just to reiterate, so do you think it's desirable?
That's the second issue. There are some debates about what are the gain of having currency, an international currency issue. So we see some papers saying that, but I think all things goes hand in hand. It may help to finance deficits and to finance debt. Okay, because having an international currency create a strong demand for this currency, and then reduce the borrowing cost. So it can be an advantage if we want to engage it in more fiscal spending for defense, for ecological or climate transition, and so on. So it can help in that way. But if we compare the returns on the sovereign yields on the US debt or on the European debt, so we see that generally the interest rates on US debt is higher than the interest rates on European debt. So there are no strong difficulties for European countries to issue some debt. So it can bring some additional advantage. But I'm not convinced that it's something that we should absolutely, it should be the priority. Okay, so that's maybe something that have some advantages, but in my view, so it's more a personal view, I'm not sure that we all share in the team those views, that I would not put this at the priority in the economic or political agenda to have the euro to be absolutely the dominant currency. Okay, so this is an international currency. Should it be dominant? It's something which is another question that puts beyond. So it's already international, So we have some benefit from that. We may reinforce them, but at the point to be the rival of the dollar or to dominate the dollar, I'm not sure that we have so strong benefits to be the first one. Okay.
Thank you. Well, actually, and thank you. Very interesting. This was actually my question, that how big is the effect to the interest rate? Because we already see that in the United States, they have a higher interest rate than France. And we say that it's terrible how big is the interest rate in France. But then talking about the European perspective, that's like very interesting. How big is the effect? But talking from the US perspective, like, is it possible that they will it will be downgraded and the dollar would still be stable? Like, could there be some kind of a, run away, like it would be some kind of a huge crisis in the world? What would happen if the dollar would suddenly be untrustable?
The issue of yield on the French debt, I guess that's more something which is related to fragmentation than the difference. Okay, and the difference between European countries. So if we think at the global level, it's not easy to see what would be exactly. I do not have some papers pricing what would be the gain in terms of interest rates. Okay, so we have some premia for the US for sure, but I have not in mind some papers really quantifying this premium. I have seen some papers saying that, so it's different perspectives, saying that the role of the dollar, the international role of the dollar, would help to have an additional 20% of US GDP debt. Okay, saying that if the dollar were not as dominant in the system, maybe they could not issue. They should reduce their debt by 20%, something like that. And what you say is that what we see and what are the fiscal plan for the US. So we have the budget which has been voted, and the perspective is to have deficits, to keep these deficits. There are no strong measure on expenditure, so we don't see permanent reduction of expenditure in the current budget, and we have strong tax reductions, tax cuts. So it means that US public debt will increase, and if the US want to maintain and to be able to have a strong demand for debt, the dollar should play a role. So that's also why I said at the beginning that it's not so clear, and it's not so easy to always find the consistencies between these visions, because they know that they need the dollar to be an international debt, to have strong demand in the financial markets, which comes from outside from the US. I guess that's so they want to keep the dollar as an important currency, but they want it to be depreciated. I guess that, in my view, one way to match those very difficult and contradictory things would be that they would accept a loss of Fed independence, and that's why maybe they put pressure on the Fed, maybe to also bring the Fed to buy debt. So to come back some old debate, not only about the COVID or the financial crisis, but something which has a strong relationship between the treasuries and the Fed at the beginning of during the Second World War and after the Second World War. The second issue that would be also to bring Europeans to buy more, military goods which are produced in the US. That would also help to finance the deficits. That if I try to find some consistencies, I guess that's the way they could go to maintain the dollar dominance and to maintain an important source of financings for the US debt.
Maybe can I come in on this one? So I remember in the 2008 financial crisis, we learned that, if you have a not so competitive economy, but you are in a currency union, so you have a distortion of your, let's say, national currency because it doesn't exist anymore. The only options you have is internal devaluation, so basically trying to lower unit labor costs to become more competitive, which can be super harsh if you don't have funds to also grow yourself out of the recession. So that means, cuts for everyone in terms of labor, and that can lead to large political disruptions, as we also saw in Greece with, I don't know, gold note. So now, if would you compare the international dominance of the dollar to such a, like, basically distortion? Because this is what I guess this Mar-a-Lago and Miran and so on seem to say, that there is a distortion to the dollar, which doesn't allow them to depreciate, even though they potentially should, which would make their products more competitive, both on the domestic market but also internationally.
Yes, that's what I interpret of the Miran's view, saying that the role of the dollar has has put some cost on the US competitiveness. But so I'm not convinced by that point. Okay, so that's why. So I try to find some consistencies in this view. I would disagree on that point, saying that I'm not sure that the role of the dollar explains the loss of industrial employment and industrial production in the US, because this is a trend that we also observe in most of European countries. Okay, so we have the same path of industrial production in France, for instance, and the share of industrial employment in France. So even if in that case it would mean that the dollar and the euro would be over-evaluated. So I guess that it's something of that, in my view, which is wrong in this reasoning and saying that. But his view is that the system has created distortion. Okay, so I'm not convinced on that point in the argument.
Very good. I think we will now continue. I'll just in the future also, please, if there are any advisors or assistants who would like to quickly make a point, I think we're such a small round that we can allow for that as well. Mrs. Beatriz Veda Di Mauro, I'll give you now the floor also for 10 minutes. You're Professor of International Economics at the Geneva Graduate Institute and the Andrew Hoffman Chair of Global Economics, Climate and Nature Finance, and you're also the President of the Center for Economic Policy and Research, the CEP. So I'll pass you the floor for 10 minutes as well.
Thank you very much, and thank you for inviting me to speak to this group. I found the discussion already very interesting, and I hope I can. My intention was to bring some complementary issues. Can I have the next slide, please, to a paper that is excellent. I wanted to dig a bit deeper on why the dollar became so dominant, and in fact go back in history to have some perspective. And then I wanted to discuss of what would it take to move to a multipolar system and take a look at what the RMB and the yuan are doing. Next, please. So here is the historical perspective, dollar dominance in the 1950s. So the world of Bretton Woods, what is red is anchoring in the dollar. This means either direct fixed exchange rates. And as you can see, there is not so much, not everything is red, because there is also countries that are anchoring in the Denmark French franc in particular, and the British pound. So it's actually quite a colorful world, although then there is an indirect link through these anchor currencies to the dollar. And then the big shock comes. Next, that's the next slide. Yeah, excerpt from the Nixon speech, which I like to use in class and to read in full because it is quite illustrative, especially these days. If you hear the tone of how this was delivered and also the topics, it is about jobs, it is about concerns for the industrial systems in the US, cuts in foreign aid. There's also some echoes there. That already was one of the policies that were announced. And what we don't have yet today, but I thought it's quite interesting to put on the slide, is a freeze on prices and wages, and dividends were also part of the package. And next slide. The most important part of this speech was, of course, in the last paragraph here. The claim was that there had been an attack on the American dollar. when really what was happening at the Bretton Woods systems, and the Americans strongly negotiated for that solution, that the US dollar be the center of the Bretton Woods system by being the currency to which all the others were linked to, and itself then linked to gold. Well, with this one sentence or half sentence, suspend temporarily the convertibility of the American dollar to gold, is basically completely unhinged the international monetary system at the time. Now, any prediction of the time would not have led to this chart here that we are seeing next. 50 years after the end of Bretton Woods, the world is even more weathered than it was before. So there is some blue now. This is countries anchoring to the euro, and in terms of territory, it doesn't look so small. And anchoring doesn't mean a fixed exchange rate; it means predominant use in trade and or finance. So there is very little other than red and blue on this chart that you can actually see. Next. So the question I was asking is why this? In particular, after Bretton Woods, there is no more institutional link that would make the dollar so dominant and central. And the answer has to lie in economic factors, therefore. Yes, the US was providing and is providing a safe asset and a safe haven. I will distinguish between the two. It has had the institutional stability, the credibility of rules, so as to serve as an anchor for value preservation, the predictability of policies and checks and balances. I'm choosing the words here that all already highlight that these things may be eroding or in danger. And most importantly, the network effects. Yes, network effects can be really powerful. And in order to illustrate that, if you look at the chart from below, which is actually speaks about the system more generally, not the currency system only, a system may have the following property, that it has a resting state at a low energy level, which is basically the lazy level where everything rolls back to. And then there may be an active state, and in terms of what I would suggest, the alternative state here is not another unipolar system, but rather a multipolar system. It requires higher energy because it will have higher transaction costs, but moving between the two states, the unipolar and the multipolar, would require going over the mountain. So it requires a large amount of energy. So what is enough to disrupt this system? Notice that globalization of trade and finance and technology will have increased the laziness of the system. So the resilience of the unipolar solution, or put differently, the magnitude of network effects. But if you do put a negative in front of these bullet points, you already also see here where the attacks or the erosion of all of these ingredients are happening as we speak. Because to the extent that globalization of trade and finance are becoming less unipolar or less globalized, that will also affect. So now I think this is important for the discussion we just had before, that I just heard before. It's important to distinguish the exorbitant privilege in terms of level effects, and this is what we can measure in the so-called convenience yield. A convenience yield is what you are prepared to pay to hold US treasuries rather than something else, because of perceived safety, liquidity, or other regulatory advantages. And the way to calculate this is the swap rate minus the maturity matched treasury yields. This is what is done in the chart on the left-hand side. And you can see that this convenience yield of the US dollar has already been eroding over a longer time. The claim in this paper is that this is mostly due to the higher debt levels of the US. Now, next chart. Differentiate from this level effect is the question whether you can finance yourself in the face of shocks, and this is the safe haven effect. Now, the US has been the US dollar has been a pronounced safe haven currency, so inflows occur in bad times, and notice that these bad times can be both at home or abroad. So the US, for instance, experienced inflows into the US dollar after the global financial crisis, which clearly was a US-made crisis to start with. Liberation Day was the big surprise in these terms. The US dollar depreciated rather than appreciated with this internal shock. So interest rates and the dollar delinked. And there was a big question around whether this is now the loss of safe haven status of the US. This is not something that Miran wants. I am pretty sure that he is not trying to achieve this. And the question was, has he achieved it, or has Liberation Day achieved that? Over the summer, the relationship has normalized. So here you see you have no longer this negative relationship between the US dollar and the VIX, which is used here as the proxy for uncertainty. So right now, financial markets have overcome that shock. But as you have already discussed before, the dollar has remained more depreciated. That is mostly due to the higher uncertainty that has been caused. But the question how the dollar reacts to shock, that's the safe haven aspect. And shocks haven't been as large as the Liberation Day since over the summer. So this question remains open. Next, please. Now, the second point I wanted to make is relating to the yuan and the RMB. So, what will it take to move to a multipolar system? When you look at the news, and especially in Asia, where I was living for a while, you would think it's already happened because of so many reports of the increasing use of the Chinese yuan also across borders. Next. So China has been actively working on promoting the international use of the RMB, and this is the swap lines that were created with a multiple number of countries. And next illustrates this. And so initially there was a view that they would not be used much, but in fact they have been increasingly used. This is the red part of the chart. And on top of that, China has also made a new effort, namely to act as a lender of last resort. So basically, it has been stepping in cases where the IMF was not prepared to extend balance of payment support. Next chart, and to a relatively large number of countries. So extending a helping hand and making friends is what I called it here. You see that geographically speaking, this is mostly in the global south and of course Russia. Next. And now on the new frontier technology, the CIPS is the payment system that China put in place and accelerated strongly after the sanctions. The use of the SWIFT, the Western payment system, cross-border payment system that were used in order to sanction Russia. So CIPS is the alternative for the yuan, the e-yuan that has been established already in China for a longer time, and now the stable coins. So the activity and the discussion these days is a lot about cross-border payments and the motivation to avoid the dollar and sanctions, and avoid having anything to do with the dollar and therefore being able to be sanctioned is a strong motivation. So this is from the official CIPS website. You see that they are advertising a large number of correspondent banks or banks that institutions which they have direct contacts and even more indirect ones. But if you look at the number of transactions, it is still a small fraction of what of SWIFT does. In fact, 8 million transactions per year compared to 53 million. These are not transactions exactly in SWIFT, but almost per day. So really, really far away, but strongly growing and driven by by strong geopolitical forces that are working into separating different realms of finance. Next. So overall, very little in terms of international reserve holding. So that's not, but maybe that's not really what they are aiming for. Ultimately, the Chinese becoming a large currency in terms of reserves holding is limited by their limited convertibility and will remain so unless they give that up. Further, next. Back to the euro and the discussion that was just there before. What would it need in order for a multipolar system in which the euro became a bigger pole? Well, I've argued strongly that it would require a big dollar shock on top of the ongoing gradual erosion. So we have a tendency to erode then, and then a shock may eventually be the same to move to a different system. In the meantime, in Europe, we have a tendency to gradually develop large or liquid safe asset pools. We may be gradually implementing the Draghi agenda. We are certain to maintain the institutional independence of the central bank. Credibility of the anti-fragmentation instrument will be crucial. Progress in integrating capital markets and fiscal policy. And therefore, one final missing agreement, next please, that I wanted to put on the table is there is a link between the international use of currencies, the exorbitant privilege, and geopolitical security guarantees. The paper that I'm citing here by Barry Eichengreen, what they show next is that countries do hold currencies as reserve currencies also as a function of who is providing the security guarantees. So this one here in particular shows Germany, Japan, and next slide. It's also true for Taiwan, Saudi Arabia, Korea, holding much larger reserves in US dollars than would be predicted by purely economic and financial considerations. So one way of saying this, and this relates to the previous discussion, is we are already paying for the security guarantees indirectly by linking ourselves to the dollar, by holding dollars. And this is not the case only in Europe, but there is a clear link over time and visible in this chart between currency dominance and military dominance. And last chart. So for the euro to have a stronger global role, we need Draghi plus, and the plus is also security. To the extent that Europe is going in this direction, the chance of having a stronger role for the euro is larger. And if I may just my own response to the question of before is there a benefit? My answer today would be a different one than it would have been 10 years ago. Under a globalized system with a very stable hegemon providing security guarantees, and where you do not have to fear that the dollar will ever be weaponized against Europe, the difference is that today I cannot be sure of any of the things I said before. And under those circumstances, having a own strategic autonomy also in terms of the use of your currency and an interest of others in the use of your currency will strengthen the stance of Europe and will make us less susceptible to possible coercion. Thank you.
Thank you so much. Let's see if there are any questions in the room. I'll give you some time to think while I ask mine. First, I have a very nerdy question. On page 16 or slide 16, you show that the other currencies increase in pink. I was just wondering which other currencies are driving this increase?
16. Wait, let me go to my own page 16 and I'll see it. Oh, I see. So your question is, so these are reserve holdings, right? So this is basically the same. Oh, I see. What the pink is the other thing.
Correct.
Well, there are a few other reserve currencies. The Swiss franc is one of them. So it could be partly Swiss franc. I don't think that they are including gold here. I would have to, get back to you to look at the exact composition. But my guess is Swiss franc is one of them.
It just looks like the decrease in the US dollar is mainly driven by the increase of these other currencies, and that's why I was wondering.
Yeah, no, I think that may be just an impression. But because there is it's not only the pink one which is increasing.
Thank you. And then I think the same question that we also heard earlier, and I think you touched a bit upon it in your last in your last words, but is it desirable to become, let's say, even more important or even dominant when it comes to the role of the euro? And also one question connected to that, what role does European debt or European safe asset play? Do you think this is also one of the crucial elements? Because in the end, I think I didn't really see that. You mentioned the safe asset, but I was just wondering what you think the role is, and if we missed a chance, for example, in the next 7-year budget of the European Union to come up with a European safe asset. Thank you.
Yes, starting with the safe asset, yes, absolutely. I mean, Europe still does not have a large pool of safe assets. By the way, it's also true, and I think this was in the paper. It's a very interesting table. You didn't show it. The overall supply of safe assets has decreased in the world as a share of GDP. And arguably the demand for safe assets has strongly increased, which is why the safe haven currencies become more important. Europe has more safe assets than it used to have. NGU has created safe assets. The ESM has created safe assets, but they are not basically. There's not one joint pool, and there have been, at the very least, what Europe should be again starting to consider very quickly are these proposals like SBs, which Phil Lane and others, have been pushing for a long time. There is a possibility of creating safe assets without having joint borrowing and joint debt, which seems to be still a very difficult thing to organize in Europe. Is it going to be impossible to increase the international role of the euro without a safe asset? To me, the answer is no. The answer in my slide was, as long as Europe is moving in the right direction and is deepening its capital markets, is increasing directionally the liquidity of its markets, it is maintaining relative to the US credibility of its institutions and of its monetary.
Can I jump in there, because it's always almost more fun if there's more interaction. So let me just ask.
Yeah. No,
if you compare, the
problem is I don't see you.
Yeah, sorry, maybe wrong microphone. Sorry for this.
Now I see
so
you.
if you
now
compare the role of the denomination of commodity trading, so whether it's dollar or euros, versus the role of safe assets, which one do you think is more important to increase the role of the international euro?
So you think that that's not a comparison I would make. I don't think we can just say, commodity trading will switch to euro without preparing the ground for that. There is a reason why the vehicle currency is the dollar for almost everything, and the trading currency for most trade in the world. So, by the way, I'm not sure if I'm responding to the question exactly, but you also mentioned before that dollar should we somehow strive for, or can we hope for euro dominance? I don't think that's the point. The world in the future will be much more multipolar, both for trade and for finance. And the question is, how big a role can Europe play in its own?
Perfect. Do we have any other questions from members or advisors? Very well. Then I would say we move on to the last round. Now you know a bit the topics we've been discussing, and you've heard your colleagues speak, so maybe you want to also react to some of the points that have been made. Mr. Ravi Balakrishnan is a visiting fellow at Bruegel, a former chief economist at JP Morgan, and former chief of the division on the euro area and EU policies in the IMF. The floor is yours for 10 minutes.
Thank you very much. Hope you can hear me. I mean, just a quick reaction on the topic. It's obviously a topic du jour, dollar dominance and the potential role of the euro. I very much agree with what Beatrice ended at the end, that it will be likely a multipolar world, that it's hard to see a dramatic decline in dollar usage for the network effect, given the network effects that you have. And it will be a combination of factors which will see further use of other currencies, which in some ways is natural. And you can have dollar depreciation at the same time, which the dollar is still in substantial use. The dollar has gone through various cycles of appreciation and depreciation over the years, and that hasn't really changed the overall dollar dominance when you take into account not just reserve use, but use as a currency. Typically, you have to have a dollar leg to any currency trade, and use in debt markets, etc. If you take it holistically, you can get dollar depreciation without a significant change in dollar dominance. Maybe let's move on to the quarterly assessment, if that's okay. Yeah. On the quarterly assessment of euro area monetary policy, good time to reassess this. I think the ECB has paused its interest rate cutting cycle since July. It's also released its strategy assessment for 2025, so it's a good time to take stock. And the title of this is Euro Area Monetary Policy in a More Shock-Prone World. I think some of that was spoken to earlier. We've got US tariff policy changes. There's many things, geopolitical tensions, announcements, regular new announcements, and this is obviously increasing uncertainty, which I think many people feel has gone up significantly relative to maybe 10, 20 years ago. So in terms of a summary of what I'm going to discuss, essentially I'm going to argue that the ECB characterization of being in a good place is reasonable in terms of managing the risks and uncertainties that are ahead. And these are significant, but they're in a good place to manage those. As Daniel mentioned earlier, headline inflation is around target right now. It's been close to 2% over the last few months. Core inflation has declined significantly. It's a little bit above 2.3%. And forward-looking indicators suggest further progress is likely over the coming months and through 2026. Turning to inflation differentials, they remain. I mean, that's natural in a currency union where you have different industrial compositions, different exposure to energy, different fiscal policies, different use of subsidies, energy price caps, etc. So it's understandable you do see some differences in inflation across the euro area, and they're still there. I mean, inflation was very low in France, for example. It was very high in Estonia and Croatia, even in August. But the differentials have definitely come down since the peaks in 2022, and by the measures that are used in the paper, they're now within historical ranges that we saw pre-pandemic. Now, in terms of the outlook, there are major external headwinds and a high degree of uncertainty. And that's obviously, I'll come on to that, the implications of that for policy going forward. US tariffs is one part of it. The geopolitical tensions are another. I think a very interesting facet is the discussion we had earlier about the appreciation of the euro against the dollar. That's something I'll also talk about. Broadly speaking, monetary policy is in a good place and broadly neutral. I'll come into some of the estimates of that. And as Daniel mentioned, it's the ECB policy is still data dependent and meeting by meeting. In terms of the balance sheet reduction has been proceeding smoothly. We've obviously had the collapse of the French government. French OAT spreads have gone up significantly since then, but it really hasn't led to any significant contagion to other euro area sovereign bond markets. We see this very clearly in Italy, where the Italian spread is around the BTP 10-year spread is around the French OAT spread, which is a pretty remarkable achievement given where we were even a couple of years ago. So no signs of contagion yet, and the ECB has tools to deal with contagion, most notably the transmission protection instrument. Now, the strategy assessment that the ECB conducted this year was really, as they say, evolution, not revolution. There's no major change. They maintained their symmetric inflation target. More focus was put on risks and scenario analysis. The question really is how to do that. In terms of communication, some upcoming issues will be when to pivot from the data dependence. And I think it's very important in this time of very high political polarization and potentially increasing further, that increasing focus and efforts to reach out to households so they understand the mandates of central banks will be important. Okay, let's turn to some of the shocks which have been hitting the euro area. One is clearly policy uncertainty. I think Christoph talked about this earlier, he had a nice chart on this. You see it very clearly in terms of the left-hand side chart. You have both the US daily trade protection uncertainty index, which is the blue bars, and you can see the composite euro area for countries, their economic policy uncertainty index. So you can see they move quite closely, especially recently. They peaked around April. The indices have come down since then, but they're still extremely elevated, which just points to the degree of uncertainty we currently see. Some things I'm not showing here is what's been happening to energy prices, for example. Certainly, energy price, reduced energy price inflation has been an important force in helping reduce overall headline inflation. We've seen that since the first quarter of this year. Oil prices have come up quite considerably relative to then. There's been some ups and downs recently, but overall they're down. Gas prices have also, European gas prices have also come down considerably since the winter earlier. So energy prices have certainly been supportive so far of inflation reduction. Supply chains don't look particularly disrupted right now. There's an index in the paper, which I don't have here, which shows it's pretty much within the historical range after the major escalation in disruptions that we saw during the pandemic. Now, as we talked about earlier, this has obviously had an impact on the euro recent developments, and despite most people's prior that tariffs would actually lead to dollar appreciation, the reverse has happened. And you see this in the euro-dollar index, which is the, I guess the colors are quite similar, which is, I guess, the turquoise line, I guess, the bottom one. And sorry, not the bottom one is actually the real effective exchange rate, I apologize. The magenta, I guess, no, not the magenta, the purple line is the US dollars per euro. That has appreciated recently. I think the more interesting one is what's happening to the nominal effective exchange rate, which is at a peak since the start of this century. Some of this reflects obviously changing weights, but I think it's symptomatic of the fact that the euro is highly appreciated. Now let's turn to the next slide, please. Here is just an illustration of really the differences in overall activity in the labor markets in Europe and the United States, or the euro and the United States. What you can see in the left-hand side chart is really over a period of time, there's been divergence between the euro area and the United States. This goes back a long way, but we also see very clearly that, because it's benchmarked on Q4 2019, that the recovery in the US since the pandemic has been stronger. We know there's a variety of reasons for that, but essentially US GDP is around 10% above its pre-pandemic level. In the euro area, it's around half that. So the recovery has been stronger. Recent data has also been stronger in the first half of the year. The year-on-year growth rates have been higher in the US and the euro area. US growth is slowing, and there are some concerns about stagflation, clearly concerns about the labor market, as we saw also in the latest Fed decision. Now, when you turn to the labor market itself, you see on the right-hand side chart, something pretty remarkable, even in both countries, despite the policy tightening cycle that we've seen and the cuts more recently, the unemployment rate didn't really move very much. In the US, it's gone up a little bit, not dramatically. It's around 4.3%, so it's not a dramatic increase from the lows. In the euro area, it's continued declining. We're at a historical low of 6.2%. So this is quite a remarkable achievement, given the monetary policy tightening cycle that we've had. Now, behind this is obviously some interesting factors. I mean, I think an important part really is labor hoarding's played a big role. And the flip side of what's happened to the unemployment rate and employment growth versus fairly weak output growth is really that productivity has taken a hit. It's starting to change now. But interestingly, we've seen significant labor hoarding, and there's a variety of reasons for that. Euro area corporates have been done reasonably well in terms of profitability, and that's allowed them to hoard labor in the face of significant labor shortages, and also the expectation that those labor shortages will continue with demographic pressures. That seems to be a very important factor behind it. Next slide, please. So let's turn to inflation and actually what we've seen. So the left-hand side chart does a comparison with the United States. We've got headline and core inflation. And the general picture is that headline and core inflation have made more significant progress in the euro area than in the United States. Part of this is because energy plays a bigger role. You can see this in the orange line, which is headline inflation in the euro area. But ultimately, headline inflation is around 2, as I was mentioning. Core inflation is a little bit above, which is the kind of dark red line. And then the blue and the green lines are the CPI inflation in the United States, which you can see are significantly above 2.5% and closer to 3%. If you looked at PCE inflation, which is the Fed's preferred measure, you get a very similar picture. Now, on the right-hand side chart, you have a measure of inflation expectations from markets, which is the five-year inflation index-linked swap. You can see that in the euro area, the blue line, that is now close to 2. It seems pretty well anchored. In the US, it's still significantly above that. Next slide, please. Okay, let's talk about how the forecasts look, and then we'll talk about some of the risks. So what we have here is basically a comparison of the latest ECB staff forecast, which came out in September, which is at the top of this table, and we compare it to private forecasts, which are reported in Bloomberg from August, the ECB's professional survey of forecasters, which was done a little bit earlier in July, and the IMF forecast from the July 2025 World Economic Outlook update. What you see generally is that inflation is predicted to stay at 2% or slightly below in all the forecasts. There's a temporary dip in 2026, which is stronger in the ECB and the Bloomberg forecast than in the IMF forecast, for example. When you get to 2027, you're largely around 2 or slightly below, both in terms of headline and core. The dip in 26 is because of 2 things. One is energy price dynamics, the base effects of what's happening with energy prices, and also the impact of euro appreciation. The question is how much of a deviation is that, and whether it's considered minor or not, given that in the medium term you're going back closer to 2. So that's obviously one focus point of discussion for the ECB. But the overall picture is that you're getting inflation close to 2 or slightly below 2 in the medium term, according to most forecasters. Now, there are very large risks around this, and they're two-sided. So to the upside, you have the impact of continued wage persistence, which is underpinning services inflation of above 3. Now, there is an expectation that wage inflation will come off, but we have to, the proof is in the pudding. But that's one element that could surprise potentially on the upside. Another one is energy prices. I mean, the skew in the risk of energy prices is probably a little bit to the upside when you compare, when you look at options pricing. Also could be further out, increases coming from defense, infrastructure investment further out, given especially the changes in German fiscal policy, and also potentially supply disruptions related to tariffs could have an impact further out in the forecast. Now, to the downside, there are also very significant risks. So to the downside, Obviously, there's concern about what the trade tensions are doing to growth. We had significant front loading in the first half of the year. That's likely to go in reverse in the second half of the year. The extent we don't know, we saw some evidence of some payback in Q2, especially if you look at the dynamics of Ireland, for example, which had growth of Q on Q, 7.4% in Q1 and negative 1% in Q2. A lot of that was linked to the export of pharmaceuticals, which were front-loaded into the first quarter. So how much you'll see more of that in the second half, in payback in the second half of the year, we don't know, and it's likely been delayed. And there's some question mark as to maybe a few months ago, people were a little bit more expecting a bigger payback. Now, with developments you see in the US and even in Europe data, the PMIs were not too bad recently. Maybe the payback won't be as strong as people think, or it could be higher. But it's certainly a risk, I'd say, probably overall to the downside relative to the ECB forecast. So that's certainly one. The impact of euro appreciation is another. That'll have a downside risk both for growth and inflation. Given the ECB forecast, which is largely a constant exchange rate, the risk that you could get further euro appreciation relative to that means the skew of that risk is definitely to the downside. So those are some of the risks on inflation. Two-sided, I would say on aggregate, probably a little bit more to the downside given the risks of weaker demand and the impacts of euro appreciation. In terms of growth, the general perception of most forecasters is that risks are slightly probably to the downside, although the ECB rightly mentioned that they're probably more in balance now than they were in June, so they're a bit more two-sided. But overall, I think many would think they're slightly to the downside given the potential payback you have from front-loading and euro appreciation. Okay, let me move on to the next slide. So in terms of the monetary policy stance, I think the characterization of broadly neutral, or I'd characterize it another way, not significantly contractionary or accommodative, is a reasonable characterization. So the rate cutting cycle, as you see in the chart on the right, has diverged a little bit from the United States. You can see the blue line has seen much more significant interest rate cuts since 2024 than in the United States. Obviously, in the United States, the Federal Reserve cut again in September, but rates are still much higher and have declined by much less than in the euro area. The euro cycle has been on pause since July at 2%, the deposit rate. Now, in terms of the neutral rate, the rate at which policy is not accommodative or restrictive, there's a large range of estimates. It's an unobserved variable. I don't think anybody has a particularly good handle on it. The range of estimates from the ECB is, in real terms, this is staff estimates. It's not endorsed by the Governing Council. Between negative 0.5 to positive 0.5. So 2%, when you translate to nominal terms, is within that range and is within the range that other forecasters and analysts have done. So this is where the broadly neutral description comes in, because 2% is within the range of neutral estimates, but although there are large caveats around that. And I think it's right that the Governing Council is treating these estimates with caution and not putting too much weight on the neutral rate estimates in their discussions. So overall, I think the ECB is a fair description to say the ECB is in a good place to deal with the various risks and shocks that I was discussing earlier. Now, in terms of the balance sheet, quantitative tightening, as I mentioned earlier, has been proceeding fairly smoothly. You can see the comparison of balance sheets in the euro area on the left-hand side chart, which is a blue line with what's been happening in the Federal Reserve and the Bank of England. You can see that the balance sheets have shrunk in all of them. Some of the discrete jumps in the ECB reflect targeted long-term refinancing operations when they were dialed up and when they were brought back down. But overall, it's proceeding smoothly. I think the important point really is on the right-hand side, which is you do not see signs of contagion from the collapse of the French government into other spreads. You see that, for example, the French spread, the blue line, has ticked up recently, but this has not been reflected in any serious move in the Italian spreads, for example, which are now at a similar level to the French spreads. And as I alluded to earlier, the ECB has various instruments to deal with contagion, most notably the Transmission Protection Instrument, which was announced in the summer of 2022. Let's quickly go to strategy. The strategy has been evolving. The strategy assessment came out in the summer of this year, kept the target symmetric at 2%, emphasized, and this is important, forceful or persistent policy responses to sustain deviations in either direction. So I think the emphasis on either direction was an important point. There was also a big focus on the use of scenario analysis, not just focusing on a baseline forecast to, given the high degree of uncertainty, and integrating that further into their strategy. The question is, how do you do this scenario analysis? It's certainly not easy. There's no consensus yet. Other central banks are experimenting with it. The Bank of England, after the Bernanke review in 24, has made a significant change in its May monetary policy review and has some clearly articulated alternative scenarios. So I think it's not a panacea. It's certainly helpful. It's very resource intensive. And to the extent that if your models don't really capture reality, then doing scenarios isn't necessarily going to help if you're using the same models. The ECB discovered this a little bit in scenarios it did around the Russian invasion in March 2022. And they did some pretty severe scenarios, but it didn't capture the full impact that we actually saw on inflation. So scenario analysis can help, but it shouldn't be thought about as a comprehensive review of a view of risk. It's really about thinking about certain pertinent risk at a point in time and using the scenarios to see their potential impact. And those scenarios can change over time. It's also useful to determine how robust a monetary policy is if you have a different scenario than the one you're envisaging in your baseline. So it can avoid the concept of large regrets in your policy decisions. Overall, though, good judgment and communication will be key, really, in terms of choosing the right scenarios and communicating them to the public and market participants. Finally, just briefly on communication, when to pivot from data dependence to forward guidance is an important issue. Obviously, the ECB's been in data-dependent mode recently, meeting by meeting. With a high degree of uncertainty, it's hard to provide very strong forward guidance. You could simply be wrong, and then credibility would be a bit lower. Certainly, as you get more comfortable with your forecast, your baseline forecast, as forecast errors decline, if there's less uncertainty, then you could put more weight on the inflation outlook relative to underlying dynamics and potentially provide soft forward guidance, which the ECB has done before in terms of direction of travel. So that's certainly one possibility. There's been significant progress in simplifying communication. I think the monetary policy statements at a glance were a significant innovation. We've seen that they're much more accessible to people in general. But overall, the public generally has a limited understanding of monetary policy. I think this is evidenced very clearly that the strategy review of 2020 to 2021 went largely unnoticed, even according to the ECB's own surveys. And BIS recently came out with a new survey, a new global survey of household expectations, and only about 50% of households have knowledge of central bank price stability mandates. And clearly, further knowledge, greater knowledge of these mandates and central bank, overall what the central bank does, actually is demonstrably has an impact on expectations and anchoring expectations. Relatedly, there's a concern about polarization and that it leads to higher perception biases. If you view the central bank as politically aligned, then you're more likely to have a favorable view of the central bank and also have lower inflation expectations. So I think the fact that we do have rising political polarization and the limited household knowledge of central bank mandates really does mean it's important to continue the efforts to reach out to households because it will really have demonstrable effects on anchoring inflation expectations. Thank you.
Thank you. I'll start with a couple of questions. The first one on your last point, I mean, there is, in the current version of the digital euro proposal, no indication that there would be interests paid on, let's say, household or retail let's say, consumer or customers or citizens holding digital euros. So there's no interest rate, also because of the risk to deposits. But I was just wondering, I mean, of course, if you had direct interest rate, access as a central bank to what to the, what is it called, the stock of value for customers, I mean, that would be a direct instrument of monetary policy which would be very much reaching the households. So what you thought of that I think I would be interested in that. And then maybe on the broader discussion we had before, I mean, maybe could you just help us understand a bit, again, the relationship between the international role of the euro and inflation? If you see, like, how are the two related, what would change? And then a third question is more about, like, the long-term view, and maybe it's more of an economist question, but, like, don't we expect a lot more cost push inflation if we have, as you said, declining demographics, potentially rising energy prices? At least, I mean, maybe there's some initiatives to decrease them, but it's not so clear. Difficulty with demand from the US and maybe more and more competition from China. So how do you think the ECB should react to this global economy? This is my three questions.
There's quite a few questions, so you may have to remind me of some of them. But on the first one, I mean, I think the community, to me, reaching out to households is not so much about the digital euro debate. I think, to me, that's a different topic about whether you provide, you pay interest on them. I mean, there's clear reasons why you shouldn't do, because you'll disintermediate the banking system. You have the same discussion about stable coins as well. And in the Genius Act, there's no interest payable on stable coins for similar reasons. We'll have to see what happens over time, but to me, the focus really is about that a lot of households just really don't understand what central banks do. It's quite technical, and it's a challenge not just for the ECB, but for many of the central banks to reach out to households. And it's really important because their expectations matter, and if they don't understand what the central bank does, then that's the problem. So I think it's a constant battle, and there's been progress with the monetary policy statements at a glance. The ECB has launched podcasts and is doing other things, but it will clearly require continued efforts in the coming years, especially in the context of high political polarization. I think your second question was about the internationalization of the euro and the impact on inflation. Yeah. So on that, I think it really depends what happens to the euro. I mean, both Beatrice and Christoph were talking about this earlier. If it would happen in a significant way and does lead to significant euro appreciation, then obviously that would have an impact on inflation. A more highly appreciated euro will lead to downward pressures on inflation. But it's not a given. As we talked about before, the dollar's had waves of appreciation, despite being the dominant currency. The third question was?
It's more a global economic outlook for, like, let's say a 20, 30-year period where
It was demographic pressures and
yes.
I think climate change, etc. Yeah.
Yeah, energy costs, demographic.
Yeah. So I think on that, the demographics is interesting. The ECB, when it did its strategy review, had two occasional papers they put out which took a deeper dive into some of these issues, which is worth reading. They're long papers, but they have a lot of interesting insights in there. And I think, when you think about demographics, you've got to think about what happens to both, in terms of thinking about impact on the neutral rate or anything, is really what happens to both demand and supply. So you need to take both parts into account. And on the demand side, I've heard different arguments. Like, a lot of people argue that as you get an aging population, they're in the retirement phase, there should be saving. That should increase consumption. Others argue, well, actually, there may be a bequest motive, and you don't necessarily see that, especially if they're more concerned about, they're having longer life expectancy, and they need to save for the fact that they'll be living for longer. So I think there's some debate, but I do think you need to focus on both sides of the coin, supply and demand, and when you do that, it's not necessarily a clear-cut one-way effect. Similarly with climate change, I mean, that's one thing I didn't mention, that climate change and climate shocks and droughts and floods, etc., becoming more common. That's leading to more inflation volatility. You see that also in food prices. Overall, will it necessarily lead to higher energy prices. I mean, I think it depends on how expensive fossil fuels become relative to the progress in terms of reducing the price of renewables. And again, I don't think it's super clear-cut, although most people think maybe in the transition period, prices may go up a little bit, and this is where you've got to think very carefully about how quick you do it and what kind of policies you put in place to support households who may face these higher prices.
Any other questions? Maybe also from the other... Irina.
Thank you very much. I have a couple of questions that related to this new approach of this data-driven meeting by meeting, which at the beginning appeared to be a sort of an emergency way of dealing with these huge shocks, but now it almost seems the new normal, because it is true that we do have uncertainty, but I mean, was there any time where we didn't have any uncertainty of this kind? I mean, I can understand like a huge external, exogenous global shock like the COVID, or, you know, but, or maybe the first months of the invasion of Ukraine. But I wonder whether this choice of sticking to this approach, is it really indeed related to total uncertainty, or maybe to unspoken awareness of the fact that existing models that we have are not capable of giving us enough elements for a real forward guidance, and so we just given up doing it because the models are not adequate enough to today's times, not just extraordinary uncertainty, but because it seems to me, frankly, that even before these big shocks, all these forecasts were often wrong. I don't know if you have any analysis in how these models have worked over time, and whether it's not just that today we are living an unprecedented uncertainty, but maybe we are living a reality that, regardless of the uncertainty, cannot be captured by some models that we have and we have been using for forecasts. So maybe we should go higher and look at the models rather than giving up in doing forward. This is just, I know it's a very complex thing too, but I'm wondering how long should we, and the other thing is that I was curious when you said that after all, you didn't see so much impact into, households, or, it seems they are pretty, don't look too much at what the ECB is doing and they don't care that much. But did you have evidence that this difference in approach has an impact on markets or on other types of economic policy? Because that's also an interesting thing. So we've changed drastically the approach. We've been wondering where is wrong, what is bad, and then maybe there's no impact. But I would be curious to know.
No, I mean, I think forecasting is an art, not a science, and you have to overlay a lot of judgment on that. And I think you've also got to remember that the ECB forecast is either done by the Eurosystem staff or it's done by the ECB staff. It doesn't necessarily represent what the Governing Council thinks. So it's not a Governing Council forecast. I think that's important to say. And I'd say that, it's been challenging for many countries. It's not just the ECB, for the Bank of England, the Bernanke talked about this issue as well in his report on the Bank of England. The Fed's had a lot of introspection as well. A lot of central banks were caught with how quickly inflation rose during the pandemic and following the Russian invasion of Ukraine. So, I think it's understandable, given the shocks are pretty, we say unprecedented too often, but very rare, having a pandemic, which we haven't seen the likes of since the 1920s, and a major war on Europe's doorstep. So those are pretty rare challenges. And your models necessarily, which have been estimated over a 20-year period when you've had the great moderation, you haven't had many shocks, won't capture that. That's a reality. So what do you do with that? Then it means you have to think about applying a lot of judgment to whatever comes out of your models. And secondly, thinking about different scenarios. I think the scenario analysis is a really important part of this, in that you may not be as confident in your baseline forecast for forecasting reasons, but also because there's just lots of uncertainty and things can change. You can get a new tariff announcement, for example. There could be a major geopolitical event in the Middle East or somewhere else. That can significantly change your view, right? So it's important to think about some of those things and not just focus on your baseline forecast. And you're right, you've always had uncertainty. Uncertainty is always with us. But I think many would argue the kind of shocks we're seeing now, climate shocks becoming more frequent as another example, mean that you're seeing more volatility in inflation. It's likely that you'll have high levels of uncertainty than we saw certainly before during the Great Moderation period. In terms of households, it's a challenge, right? I mean, central banking it's important for them. I mean, what happens to interest rates and inflation is very important for households, but a lot of them don't necessarily, unless it's affecting their food basket or, the prices at the pump, they won't necessarily register with what the central bank's doing or thinking. And that's an issue which all central banks face. A lot of it is quite technical, and it's a challenge, but I think it'll be important to think about ways of communicating in simple ways, which some of these statements at a glance did do, in making them much shorter, more visual, thinking about ways of getting across the purpose of the central bank, what it's trying to do, and how important price stability is.
Thank you so much. This actually, for me, has been a super insightful meeting. I think it will definitely inform our conversations that we will have with the President of the European Central Bank in 2 weeks. I think, a lot of the assistants here will brief the MEPs, the members of Parliament, accordingly. And I hope that all of us will deep dive into your papers and review the presentations you gave. So for me, it was an honor and a pleasure to really learn from you. Thank you so much. And I think I speak for all the others in the room as well. And for all the members, again, the monetary dialogue with President Lagarde will be on in 10 days, Monday, 6th of October in the evening. I'll close the session with this. Thank you so much.
Thank you. Goodbye.